Welcome to the deep dive. Today we're really getting into it, looking at this tense connection between traditional finance, TradFi, and the crypto market.
Yeah, it's a critical moment. We've gathered quite a bit of reporting on this growing stress in the banking sector, particularly in the U.S.
Exactly. And our mission today is pretty clear. Is Bitcoin actually acting as an early warning sign? Is it smelling trouble, like some are saying? Because that's the core idea we're digging into, this pretty provocative thesis from Jack Nollers, the CEO of Strike.
Right.
He basically said, point blank, Bitcoin is accurately smelling trouble right now. Strong words.
Very strong. And timely, too, when you look at the context. The sources we're analyzing definitely show measurable strain coming back into the U.S. regional banking system.
So if we thought might be behind us.
Sort of. We're seeing names like Zions Bank Corporation, Western Alliance Bank, their stocks taking sharp hits. And it's linked to, commercial real estate loan defaults creeping up, yields doing weird things.
Okay, so real systemic stress signals are flashing.
They are. And the key thing for you listening in is figuring out what that means. If liquidity tightens, if banks struggle, what does that actually do to crypto prices? So our goal here is really to unpack Mahler's claim. Is Bitcoin pricing in this broader system stress? Is it anticipating maybe more emergency cash injections from central banks?
And give people the tools to watch for it themselves.
Exactly. We want to point you to the specific indicators, the things you need to monitor to figure out this risk-reward situation.
All right, let's start with that banking backdrop then. It does feel a bit like deja vu from 2023. I thought reforms were supposed to fix this, but the sources suggest maybe not.
Well, the reforms happened, but the underlying risks, they seem to persist. The sources point to a few key areas still causing trouble for these regional banks.
Like what specifically?
It's a few things. High exposure to commercial real estate, that's a big one. Still got those unrealized losses on bond portfolios from when rates went up.
Right, the duration risk.
Exactly. And then there's always the potential for deposit flight if confidence wavers. So you put those together, it still looks quite fragile in places.
Which loops us right back to that Mahler's quote. He said something like, yields are puking, spreads blowing out.
And banks are stressed.
Yeah.
Bitcoin is working. It smells trouble.
Yeah.
It's a very vivid way to put it.
Okay, hold on, though. Yields puking, spreads blowing out. These are trader terms. Can we break that down? What does that actually signal to someone watching?
Good question. It's crucial. So yields are puking generally means interest rates on bonds, often government bonds like treasuries, are falling really fast.
Okay.
Bond prices go up when yields go down, and that usually happens when the market starts aggressively betting on an economic slowdown or even a recession. It's like they're forcing the Fed's hand, expecting rate cuts.
Pricing in easing before it happens.
Justly, and then spreads blowing out. That's about the difference in yield between a safe asset like a treasury and a riskier one like a regional bank bond. When that spread, that difference, widens dramatically, it means investors are demanding way more return to take on the bank's risk. It's a direct measure of fear of default, basically.
Gotcha. So Mahler's is saying Bitcoin sees the falling yields, the widening spreads, and reacts almost like a truth machine for the system's health.
That's the implication, yes, that Bitcoin is reflecting this deteriorating macro picture, sometimes even before the mainstream stock market fully panics.
We saw how fast things can unravel back in 2023. Silicon Valley Bank, Signature. It doesn't take much for contagion to spread.
Exactly. That memory is definitely playing into the current anxiety. People remember how quickly regional issues became systemic ones.
Which brings us to Bitcoin's role.
Yeah.
If it's this canary in the coal mine, why? I mean, why would this volatile crypto market be better at sniffing out trouble than, the giant TradFi system itself?
Yeah, that's the million-dollar question, isn't it? The sources describe Bitcoin as maybe the asset most sensitive to liquidity changes.
Why, though?
Well, think about it. Bitcoin trades 20/47 globally, often with significant leverage available, unlike stock markets with opening hours and circuit breakers.
Right, it never sleeps.
Exactly. So any shift in global credit, any change in money supply, it hits the crypto market instantly. There's no delay. It's like this continuous high-frequency stress test. It reacts sometimes quite violently to liquidity tightening before other markets even register it properly.
So that sensitivity gives crypto traders a potential heads up, even if the first move is down.
That seems to be the idea. It's an early signal of pressure building in the financial plumbing, even if Bitcoin itself takes a hit initially.
And we kind of saw that recently, right? When this banking stress news flared up, Bitcoin dropped pretty hard, hit a 4-month low for a bit there.
It did, before recovering somewhat. And that perfectly shows the two sides of this coin, doesn't it?
How so?
When the system tightens up, when credit gets scarce, Bitcoin often acts like any other risk asset. People sell it maybe to cover losses elsewhere or just reduce risk, so it goes down.
Okay, that's the immediate reaction.
That's the immediate pain, potentially. And this is the core of the Mahler's argument if that banking stress gets bad enough.
Bad enough to force intervention.
Exactly. If it forces the Fed or other central banks to step in with massive bailouts or liquidity injections, well, then Bitcoin is suddenly in a prime spot.
Because of the money printing narrative.
Precisely. Mahler's pointed to path rallies, like after the huge easing in 2020. The idea is, if they have to flood the system with cash again to save the banks, Bitcoin, being sensitive to liquidity, will move first again and outperform everything. It soaks up that new money.
So it benefits from the solution to the crisis it potentially signaled early.
That's the thesis. It gets hit by the problem, but benefits immensely from the cure, potentially more than other assets.
Okay, so for you listening, this boils down to basically two potential paths forward, right? Two scenarios to keep in mind.
Yeah, broadly speaking, the sources suggest two main outcomes you need to watch for.
Scenario A. Let's call it the rally scenario. This is Mahler's bet. Banking stress gets worse. Spreads keep widening. Maybe more banks wobble. And that forces the Fed, or others, to open the liquidity taps wide. Big injections. In this case, Bitcoin takes off, maybe even before stocks, acting as that hedge against the monetary response.
Right. Bitcoin thrives because the cure involves debasing fiat currency, essentially.
Then there's scenario B, the struggle scenario. Here, maybe the banking stress is contained. Maybe it's just a few isolated banks, no major contagion.
Right. The authorities manage it quickly, maybe without needing massive system-wide liquidity.
So no big money printing event in that case. Bitcoin might just continue to struggle along with other risk assets because the catalyst for that big liquidity-driven pump never arrives.
Exactly. It might just face the headwinds of tighter credit for longer without the offsetting flood of new money.
Okay, that makes sense. So how does knowing these scenarios help people actually make decisions? Like, does it mean different things for a long-term holder versus someone building in Web3?
It definitely frames the current environment differently depending on your perspective. For long-term Bitcoin holders, this whole situation, it doesn't really change the core belief, does it?
And no, I guess it reinforces it.
Right. It underlines the argument for holding Bitcoin as sort of insurance against exactly this kind of banking fragility and potential monetary craziness. The stress just makes the thesis seem more urgent, maybe.
And for builders, people working on DeFi projects.
Well, if TradFi looks shaky, if people start worrying about their bank deposits again, that could actually accelerate interest in decentralized alternatives, right?
So it could drive adoption towards DeFi and self-custody.
Potentially, yes. Moments of TradFi stress often highlight the potential benefits of non-custodial finance and alternative systems, makes the DeFi value prop clearer.
Okay. And for shorter-term traders trying to navigate this, they need more than just a gut feeling about which scenario is playing out. They need concrete signals.
Absolutely. Relying on instinct here is tough. The sources highlight a few key indicators you should be tracking very closely right now.
Let's list them out. What's first?
First, just watch the regional bank stocks themselves. The indices like the KRE or individual names, are they stabilizing or continuing to fall? That's your basic sentiment check.
Okay, bank stocks. What else?
Second, keep a really close eye on those credit spreads we talked about, especially bank bond spreads versus treasuries.
If they're widening.
If they're widening significantly, that signals rising fear of default. That pushes us more towards scenario A, the intervention needed scenario.
Got it. Spreads widening, more stress. What's third?
Third, treasury yields themselves. Are they still puking? Are those longer-term yields falling sharply? Particularly watch the relationship between the 2-year and 10-year yield.
And falling yields mean?
Falling yields generally mean the market is strongly anticipating the Fed having to cut rates soon to combat weakness. Again, leaning towards scenario A conditions.
Okay. Bank stocks, credit spreads, treasury yields, anything else? Maybe crypto-specific.
Yes, definitely don't ignore the on-chain data. Look for significant movements of Bitcoin off exchanges.
Why off exchanges?
Because large outflows often suggest accumulation. Whales or long-term holders moving coins into cold storage. taking them out of circulation. If that happens during macro stress, it suggests smart money might be positioning for that scenario A outcome, anticipating the liquidity injection.
Right, betting on the eventual rally.
Could be, yeah. So watching those flows gives you a crypto native read on sentiment. So putting it all together, Mahler's comments really highlight that crypto isn't in a vacuum, is it? It's deeply connected to the wider financial system, especially through liquidity and credit.
Yeah.
Bitcoin might be that canary, signaling trouble early because of its sensitivity.
And this is the crucial takeaway, I think. Being the canary doesn't make you immune to the poison gas initially, right?
Exactly, that's the tension.
So the big question for you listening is, could Bitcoin fail this time? Even if banks get into trouble, could the initial reaction be so negative for all risk assets, including crypto, that it gets hammered first?
It's possible. That scramble for dollars in a credit crunch is powerful. The immediate pain versus the potential long-term gain from intervention, that's the dynamic you have to watch.
So the advice is basically, stay alert.
Stay alert, definitely stay diversified, and crucially, use these macro signals. Don't just look at crypto charts in isolation. This TradFi stuff matters deeply.
Absolutely. And look, bringing you this kind of analysis, digging through the sources, connecting the dots, that's what we aim to do here on the Deep Dive.
Yeah, it takes effort to sift through it all.
It does. And honestly, the best way you can support us, help us keep doing this, is by engaging. If you found this useful, if it helps you navigate these tricky markets, please do consider subscribing, hitting that notification bell.
It really does make a difference with how these platforms surface content.
It really does. Likes, comments, especially your thoughts on scenario A versus scenario B. We'd love to hear them sharing this.
Yeah.
It all helps boost visibility, tells the algorithm this is valuable stuff.
And lets us keep making more of it.
Exactly. It lets us keep bringing you these deep dives into the signals that matter.
So stay informed, everyone, and stay ready.
We'll catch you at the next Deep Dive.